Okay, so here we are with this week's mortgage market update. So we're going to talk about quite a few things. There is definitely no shortage of negativity from the media and some really smart economists as it pertains to the housing industry. So what do we have? What are we seeing? Last Wednesday, we got the report on housing starts. That number was not a positive number overall. It was better than expected month over month. Year over year, housing starts did improve quite a bit. There's more supply coming to the market. This gets the media riled up because they sort of freak out about too many homes coming to the market in too short a time being an oversupply of inventory. And this could be troublesome for the market, but that is not what we expect to happen. On the single family home side of the market, which makes up about 2/3 of the market, it's only up 4%. Household formations and destruction of housing counteracts that. So only housing starts of new construction create new supply. So when someone sells or lists their property, they typically would be buying another property. So that does not create new supply in the market. The bottom line is that we still have a huge shortage of inventory, which will still keep the value strong on housing. We estimate conservatively that we have a shortage of about 1 million homes nationwide. Looking at household formations, this is important. We look at birth rates from about 30 to 33 years ago because that's the average age of a first-time home buyer. So that's when there's a lot of demand for housing in the market. The media tends to want to talk about the low birth rates right now, but that won't be affecting our housing market for like another 30 years, 25 or 30 years. So we do expect demand. There was a big boom 30 to 33 years ago in birth rate. So we expect demand to stay high for a number of years still. The MBA, the Mortgage Bankers Association mortgage application report, mortgage applications were down 11% overall. Purchase mortgage applications were down 12% week over week, so this week since last week, and then they are down 15% year over year. Refinances are down 10% week over week, and they are down 76% year over year. And again, I said this last week, but we definitely see that change. All of this is in the face of the interest rates being up about 2 3/8, which is 2.375% over this time last year. Existing home sales for the month of April is a very important report. Houses that are existing, so freestanding houses already built, they make up about 90% of the housing market. So it's a good sampling. And this report depicts the closed transactions for the month of April. So it would have been buyers shopping in February, March, and possibly early April if they got a fast closing in from, April 1 to April 30th. Interest rates were lower in February than they are now. So we've had about a 1% increase in mortgage rates since February. So as the snapshot, the numbers are still good. Month over month, we are down 2.4%, and year over year, we're down 5.9%. This is on existing home sales, and this is for the month of April. Inventory is a lot lower than it was a year ago. Interest rates are higher than they were, and prices of homes are higher. So to see us be down just 5.9% is not terrible considering all of those things. Homes are selling quickly. They are averaging 17 days on the market from the time they're listed till the time they go under contract. Prices are still going up, and the median home price nationally is up by 14.8%, and that median home price is $391,000. With an inventory supply of only 2.2 months, the market is still pretty active. The percentage of first-time home buyers has dropped from 30% to 28%, and this number has been vacillating. First-time home buyers could be having a harder time with the higher rates, higher prices. It could be just a stretch for some of them. Over the next couple of months, we'll be getting some readings that are more reflective of where interest rates are now. So as we see the existing home sales for the month of May and then the month of June, that will be reflecting how consumers are responding to the interest rates that we're experiencing right now, which are about 1% higher than they were 2 months ago. So it won't surprise us if we see things slow down overall and take it easy from those really high levels that we had been seeing over the past 2 years, 2+ years. Employment, as far as employment goes, initial jobless claims were higher on this report. They were up 21,000 to 218,000 total jobless claims. The 4-week moving average on that number has been higher. If we want to keep an eye on this number, because if this number keeps rising, that would increase the unemployment rate, which would be an early recession indicator. The Philly Fed Manufacturing Index for the month of May was a big miss. We were expecting the number to be 15. It came in at only 2.6, and this was the weakest reading since May of 2020. As far as the equity and stock markets go, the S&P 500 is showing only 1% away from being a bear market. A correction is when the market is down 10% from its high. A bear market is when the market is down 20% from its high. The NASDAQ is down 30% and the S&P 500 is down almost 20%. The S&P 500 is an index of 500 stocks, and it represents 83% of the total stock market value. Just 5 stocks in the S&P 500 make up about 20% of the value. The other 495 make up the other 80%. So the top 5 stocks are very influential to the performance of the stock market overall, the S&P 500 overall. And can anyone guess what those 5 are? Here we go. They are Google, Amazon, Apple, Microsoft, and Berkshire. And as they go, that's how the trend goes. As far as inflation, we are still seeing inflation happening. Last week we talked about the gas prices at the pump for our cars. This week we're going to talk about the jet fuel that airplanes use. Jet fuel is about 30% of an airline's cost, and airfare is up 33% year over year. And airfare is up 18% month over month, and people that are traveling are definitely feeling that. As inflation rises, we see the negative wealth effect. So during the pandemic, the US gained 40 trillion in wealth, and so far they have lost 5 trillion. And for every $1 lost in wealth, Americans spend 5 cents less per dollar. So this will definitely affect their spending. Next, let's talk about the new home sales. They were much lower. So waiting for a new home is the hardest part for consumers, especially in an uncertain market with the uncertainty of interest rates and then the uncertainty of the cost of what the home will be. It's hard to get a clear answer on what the cost of a new construction home will be for consumers. Builders are putting in clauses where the cost could go up and things like that. So it's tough for consumers to be making the decisions to buy the new homes in uncertain times, especially they don't know how long it will take to build. The time frames are not clear, they're uncertain. The interest rate environment is uncertain right now, and the cost is uncertain. So those numbers are down. Month over month, as we said, the mortgage rates are up by about 0.75%, but the new home sales year over year are down 27%. And we had been seeing some really big numbers. COVID definitely spiked new home sales because people were not wanting to buy existing homes that people had already been living in because of like the fear of contracting COVID. So we saw a spike in new home sales during COVID, and then recently again with Omicron. So we're seeing a slowdown all over. Manufacturing is no exception. We do expect a recession on the horizon. The Fed plans to hike the Fed's funds rate. The plan is to hike it 50 basis points in June and then 50 basis points in July. They have not been clear about their plan for the next Fed meeting after that. We could very well see a pause. And if you hear this term that the Fed is taking a pause, you want to turn your attention back to your stock portfolio, because this may be when your stocks start to look better. This coming week, we will be looking for pending home sales. this is going to tell us a different story than the new home sales, and we expect to see a slowdown in appreciation. That's clearly coming. We don't expect home values to go down, but back to a more normal level of appreciation, which is really about 3 to 5%. So there you have it. That's the mortgage update for this time, and I hope to see you next time. See you then.